All right, welcome to this explainer. Today we're putting on our sell-side equity analyst hats because we are doing a complete, rigorous, fundamental stock valuation of PriceSmart. We're going to build a step-by-step discounted cash flow, or DCF model, and we're relying strictly on the hard data from their latest 2026 earnings reports, overview presentations, and financial filings. The goal here? To cut through the market noise and ground every single assumption in the actual reality of the business. So let's just dive right in. Here is our roadmap for today. We'll start with the business model and competitive position, look at segments and industry trends, derive our free cash flows, estimate the cost of capital, build our forecast and terminal value, and finally arrive at an intrinsic value. Kicking things off with part 1, the business model and competitive position. We've got to ground this valuation in actual operating reality. Now, to set the stage, we're anchoring our analysis against the current stock price of $158.03. That's the market's current valuation as of May 2026. By the end of this explainer, we're going to figure out if this price is a massive bargain, fair value, or just entirely overpriced. Before we even think about crunching the numbers, we have to understand how PriceSmart actually makes its cash. According to their 2026 overview presentation, they operate 56 U.S.-style membership shopping warehouse clubs across 12 countries in Latin America and the Caribbean. Think of it like bringing that classic Costco-like experience to emerging markets. Honestly, their DNA is tied right back to the founders of Price Club, literally the pioneers of the warehouse model. The whole shebang is about high-quality merchandise and essential services at distinctly low prices. So looking at the product-level momentum we pulled straight from the Q1 call, we're seeing some really solid double-digit growth in foods. But what absolutely jumps out is the 17.8% surge in health services, stuff like optical and pharmacy. Plus, you've got their private label brand, Member Selection, making up a massive 27% of total merchandise sales. That's a huge competitive advantage. It acts like a moat, protecting their margins, while still letting them offer lower prices. It gives them tons of leverage with national brand suppliers. All right, moving on to part 2, segments and industry trends. Let's look at geographic growth and real estate expansion. If you check the filings, you see broad-based growth everywhere. But Colombia? Colombia is the undeniable engine right now. Thanks to some serious consumer demand, comparable net merchandise sales there surged 14.7% in constant currency. Basically, if you strip out the crazy exchange rate fluctuations, the underlying volume is just booming. Management actually pointed out that Colombia contributed 320 basis points. That's 3.2% of positive impact to overall consolidated sales. And the Caribbean and Central America, they're showing steady, robust growth too. To really nail down our upcoming revenue forecasts, we absolutely have to track their active physical expansion. Management has laid out a clear target to hit 61 total operating clubs, with upcoming openings scheduled everywhere from the Dominican Republic to Guatemala. They're also actively laying the groundwork to enter Chile, which honestly is a massive new market opportunity for them. But hey, as prudent analysts, we've got to price in the material risks, right? And here's a big one: severe currency exposure. Nearly 81% of their sales are in local currencies, but almost half of their imported merchandise is bought in US dollars. This is a very real issue highlighted in their Q1 filing, where they reveal having $80.2 million in cash basically trapped in Trinidad because it can't be readily converted back to US dollars. That illiquidity is a tangible risk we simply can't ignore. Which brings us to part 3, deriving free cash flows. This is where Act 2, the valuation engine, really kicks into gear. The absolutely crucial point here is calculating our unlevered free cash flow, or FCFF. We use FCFF because it shows the true cash-generating power of the core retail business, totally independent of how management decides to finance it. It's really the cleanest metric you can use for an operational valuation. Okay, let's build out the bridge. Using the Q1 filings, we start with $71.2 million in net cash provided by operating activities. Now, to find our normalized cash flow, we have to strip out a $10 million benefit from working capital improvements, like some specific VAT receivable recoveries, because those just aren't always going to recur. Then we subtract the $10.4 million in property and equipment capex. That leaves us with a clean proxy unlevered free cash flow of $50.8 million for the quarter. Now, to keep this model perfectly rigorous, I need to declare an assumption here. Because the quarterly text we have omits a full 10K breakdown that separates maintenance capex from growth capex, we have to make an explicit estimate. Given that aggressive 5-club real estate expansion pipeline we talked about, we're going to assume 50% of that expenditure is growth capex for the new locations. Moving right along to part 4, estimating our cost of capital. Time to calculate that WACC hurdle rate. You can basically think of the weighted average cost of capital, or WACC, as the average rate the company pays to finance all of its real estate, distribution centers, and that massive inventory. We figure this out by balancing the cost of equity against the cost of debt based on their target capital structure. The cost of equity comes from the capital asset pricing model, while the cost of debt looks at what they actually pay to borrow. And once again, I have to declare some external assumptions. Since a specific historical beta and exact debt interest rates are missing from these specific excerpts, we're relying on sensible analyst defaults. We're assuming a beta of 1.1, which means we expect the stock to be about 10% more volatile than the broader market. That totally makes sense for an emerging market retailer. We're also applying a standard 5.5% equity risk premium. So, assuming a highly equity-weighted capital structure of 85%, which aligns nicely with their strong cash balances over debt, we blend a 9.5% cost of equity with a 5.0% after-tax cost of debt. When you combine those, boom, you get an estimated WACC of 8.8%. This 8.8% is absolutely critical because it acts as the discount rate for our entire model. All right, part 5, forecast and terminal value. Let's project those future cash flows. Based on their really robust Q2 net sales growth of 9.9%, plus those 5 new clubs scheduled to open, we're modeling an initial high-growth phase. We project an 8.5% revenue jump in year 1 as those new Caribbean and Central American spots come online. From there, we naturally normalize that growth down to about 6.5% by year 3 as those new stores start to mature. Then we have the terminal value, which is essentially the worth of the company for all the years beyond our 5-year forecast. Here, we have to make one final major assumption, a 2.5% perpetual growth rate. Why 2.5%? Well, it aligns perfectly with long-term GDP expectations in their primary target markets across Latin America and the Caribbean. Finally, part 6, intrinsic value and conclusion. Let's bring this whole valuation model together. This step-by-step calculation is where we see exactly how that projected operational success mathematically translates into total equity value. First, we pull in $1.2 billion from our 5-year explicit forecast. Next, we add the $3.5 billion from our terminal value. That gets us to a total enterprise value of $4.7 billion. Then, we just subtract an estimated $200 million in net debt, landing us at a total implied equity value of roughly $4.5 billion. Now, if you divide that $4.5 billion equity value by the total shares outstanding, our model gives us an illustrative intrinsic value of $148.50 per share. Remember our anchor from the start of the explainer? The market is currently trading PriceSmart at $158.03. So what does this tell us? It suggests the current market price might already be pricing in the flawless execution of their aggressive store pipeline and maybe even a highly successful bump-free entry into Chile. So I want to leave you with this final thought. Based on the fundamental filings we just tore down, does their aggressive 61-club expansion and robust double-digit sales growth justify paying the market's current premium? Or do the very real threats of $80 million in trapped Trinidad cash and an 81% foreign currency exposure demand a wider margin of safety? That is the question every investor has to answer. Thanks for hanging out with me on this explainer, and remember to always keep questioning the numbers.